All right, so the place we're going to start is just thinking about what are the options for where we can put our money. Different types of accounts that are available to you, and these are the most common ones. There are others that we might touch on in future lessons, but these are the most common and most basic ones that most of you and most of your students might be thinking about. We've got a checking account, a savings account, and a high yield savings account. You find most of those at your traditional bank branches. Checking accounts are where money goes in and out on a regular basis. It's linked to a debit card, and this is pretty much our spend account. This is where most of our transactions are done. A savings account is usually a very similar type of account. It often has some rules on it in terms of minimum balances that have to be kept, number of transactions that you're allowed to have. So for example, in my PNC savings account, I can only have 5 transactions per month before they charge me a fee for it. And then a high yield savings account is just a savings account, but a high yield means that it has a higher interest rate. We typically find these in online banks as opposed to traditional brick and mortar banks. A money market account is another type of savings account with a couple more rules. Again, usually you maybe are only allowed 1 or 2 transactions per month. So the banks are looking for you to lock your money in there for longer periods of time so they can make more money from it. Money market accounts will usually pay a higher interest rate than just a typical savings account will. Longer term again is a certificate of deposit or a CD account. This one you are committing to locking your money in for a given period of time in return for a higher interest rate. So we can see monthly, 6-month, 1 year, 2 year, 5 year, 10 year CDs. So you can look for a longer term. So that's how long your money's in there for. And in exchange for that longer term, you will probably get a higher interest rate offered to you. So once again, banks want you to save your money with them, leave it there untouched for longer periods of time. This allows them to take that money and loan it out to other people or invest it themselves and try and make a higher return than what they are offering you. A brokerage account, this is an account where you can buy and sell individual stocks or bonds. So you're allowed to hold these sorts of assets in this account. So you can't do that with a traditional bank account. You have to use a special account called a brokerage account. There are retirement accounts, which you can also do these in. We're going to talk about those later. So this is more so like where can you put your money right now that you could potentially access it if needed. And then the final one I want to throw in here is a newer one, and that's a cryptocurrency wallet. So if you are going to have money that is in cryptocurrency as opposed to the US dollar, then you're going to store that in a cryptocurrency wallet, not in a traditional bank. And we want to talk about maybe what the pros and cons of that are as well. When thinking about which option to use, here are the questions I want to ask you to think about. The purpose, so what is this money for? And it could be short-term goals, long-term goals, a sinking fund, runway, or retirement. So short-term goals might be things like I've got a purchase coming up in the very near future. Like I want to save up for a quick vacation in a month's time or something like that. Long-term, we're talking maybe like 6 months to a year plus. So these are bigger goals that you are saving for. And what we would say here is that if your goal is between, let's say it's less than 5 years. That's a good tip to go off of. So if it's less than 5 years, then your money should be saved, not invested, just because of the risk that comes with investing for your money increasing or decreasing in value. So like say you're saving for a house down payment. If you're planning on buying that house within the next 5 years, your money should be in a savings account, not in a brokerage account. So it shouldn't be invested in the market. Sinking funds, these are for large expenses that happen pretty much on a regular basis and maybe like once a year or twice a year. And you just create a savings account for that particular thing. Big example I have is like my HOA bill is due once per year. Christmas, a car replacement fund. So it's an expense you know is coming. It comes on a fixed time period and you just save a little bit every month or every paycheck towards that larger expense. This is what we call a sinking fund. So it's not like something fun, like going on a vacation, but it's an expense you know it's coming, and it makes sense to try and save for an entire year for it rather than it coming up on a particular month and you having to try and scramble to find the cash for it. Runway, this is usually like you want to increase your amount of cash that you have available because you're planning on doing something that maybe potentially reduces your income or increases your expenses. Best example I have of this is you're planning on changing jobs, or maybe you're planning on starting your own business. So you're saying, I want to quit and I want to give myself time to go find a new job. Well, you would increase your savings to allow you to draw from that whilst you are searching for a job. If you're going to start your own business, then it's likely you're going to have higher costs in the beginning and maybe not making as much money in the beginning. So having a large savings pot to draw from to kind of bridge any gaps in your budget is going to be an important thing to have. And then retirement accounts, this is the other part that we're going to keep some money in our savings account, and we're going to not put it in retirement accounts. And the reason for this is to diversify your risk, so that if there comes a time where the stock market is crashing, kind of like what we had in early 2020, that some of your money is still in cash and you can withdraw that and live off of that while you wait for the stock market to correct itself and come back to where it should be. One thing I didn't put in here was an emergency fund. This one kind of gets its own line because it's such an important thing for everyone to have. So we talked about it in our live session, but when we are budgeting or when we are thinking about our finances, it's really important that we start first off with what we call a crisis fund. So this is something that stops you from using your credit cards when something unexpected comes up. I like to say it's usually around like $1,000 to $2,000. So it's not going to fix every problem in your life that pops up, but it's going to cover a lot of those unexpected expenses that seem to just kind of arise out of nowhere. Like you blow a tire, a window breaks in your house, something like some appliance of yours breaks and needs to be replaced. Like not like your roof needs to be replaced and you're like, okay, that's a $10,000 expense. But a lot of the things that do pop up could be covered by a $1,000 to $2,000 emergency fund. After this is built and you've put some of these other steps in place that we've talked about or we will talk about, you then step up to what's actually an emergency fund. And an actual emergency fund should be about 3 to 6 months of your core expenses. So core expenses are if you had to pretty much tighten your belt, you lost your job, someone got sick, you got really hurt, and income dried up. What would be the absolute necessary expenses that you had to cover each month? So talking about things like your rent or your mortgage, putting food on the table, keeping the lights on, keeping the heat on. Those are your core expenses. Anything that you could get rid of, like I can cut Netflix out this month, I can stop eating out, that kind of like entertainment stuff can go. That's not part of your emergency fund. Your emergency fund is like, okay, we're in an emergency state. I need 3 to 6 months of runway here that I can use. So a runway fund would be more than that. So you're saying, okay, I might have a 2-year runway in case my new business doesn't really work out, or to search for jobs and maybe hop around a little bit to find the right situation. So 3 to 6 months of core expenses would be what most people consider a true emergency fund. And then a lot of people might increase that to 12 to 24 months, depending on how risky maybe your job is or how comfortable you feel. So as public school educators, which is most of us, we are in a very secure job for the most part. Even in the height of the pandemic, there wasn't really any question of teachers being cut from the workforce, being furloughed, going unpaid, anything like that. It's, as you know, very difficult to fire a teacher. You can get excess, but usually you get placed within another building. So the chances of your income just disappearing are pretty low. So you can have a smaller emergency fund if you feel comfortable with that. But if you say have a spouse who works on commission, or they have their own business, or it's a very seasonal business, that's something that might be a little bit higher risk, and it might make more sense to have a larger emergency fund as a result of that.